Hey there, financial aficionados. Welcome back to the Legend Finance channel. Today, we're diving deep into the world of tax-free savings accounts, breaking down their pros and cons to help you make informed decisions. Don't forget to hit that like button and subscribe for more financial insights. Let's jump right in. What is a TFSA? Welcome to your guide to the tax-free savings account, TFSA, for Canadians. Introduced in 2009, the TFSA has been Canada's tool to foster more savings and investments for a brighter future. While it might sound like just another savings account, it's truly an investment powerhouse. With most investment avenues, taxes often take a bite out of your growth, but the TFSA changes the game. The Canadian government designed this to alleviate some of that tax burden, offering a refreshing break for investors. It's crucial to note that the TFSA is more than a place to park money. Harnessing its potential means investing, not just saving. For instance, investing $10,000 and watching it double comes with no tax strings attached in a TFSA. While there's value in traditional savings accounts, the TFSA stands out as an investment champion. Saving money is not the only important thing. Thriving investments are also important, and the TFSA's tax-free shield protects them all. Benefits of a TFSA. Having a tax-free account like the TFSA is vital for one main reason. It supercharges your investments. Here's how. Interest earned. This is the amount you accumulate from various vehicles like savings, GICs, or bonds. Instead of just saving, your money grows. Dividends. Think of this as a reward for investing in successful companies. When businesses prosper, they often distribute a portion of their profits back to shareholders. These are your dividends. Capital gains. This is the increase in the value of your investment. If you purchase an asset and later sell it for more than your initial amount, that profit is a capital gain. Now, the magic of the TFSA is that all these gains, interest, dividends, and capital gains, remain untaxed, so every cent of growth stays in your pocket. To grasp the full power of the TFSA, it's essential to understand the concept of purchasing within the TFSA, which ensures your earnings remain tax-free. The TFSA is an investment account. The key thing to grasp about the TFSA is its nature. It's an investment account, not the investment itself. Consider the laundry basket analogy. The TFSA is your empty laundry basket at the start of the week. As the week goes on, you add clothes, or in the world of investments, assets. So as you acquire more knowledge and decide on investments, you're essentially adding clothes to your laundry basket or investments to your TFSA. To break it down, the TFSA is where your investments reside. Now, what can you put in this TFSA basket? You have options like individual stocks, bonds, and various funds like mutual funds, ETFs, and index funds. Additionally, you can include REITs, real estate investment trusts, and even cash. How do we open a TFSA? Utilizing a TFSA involves a few steps. First, decide on a platform. You've got two main choices. Traditional route. This involves opening a TFSA through your bank. You can do this in person or online. Online brokerage. Opt for a low-fee online brokerage and set up your TFSA directly on their platform. No matter the route you choose, remember to specify that you're opening a TFSA account. Once that's done, your main task is to determine which investments to add. Simply purchase them within that designated TFSA. Having covered the groundwork, it's worth noting that while the TFSA can appear straightforward, it comes with its own set of regulations. What is the contribution limit? TFSAs have a key feature known as contribution limits. This dictates the maximum amount you can deposit into your account annually. The rationale behind this is simple. Without such a cap, everyone would lean heavily on a tax-free account, and no one would want to pay taxes on investment income. Can you lose contribution room? You're not limited to just one financial institution or one type of TSA product. It's perfectly legal to have multiple TFSA accounts spread across various banks or brokerages. However, while the freedom of having multiple accounts can offer flexibility and diversification, it also comes with its own set of challenges. The key challenge is that, irrespective of the number of TFSAs you have, your total contribution room remains the same. The number of accounts you have does not multiply it. This means you must remain diligent in tracking the total amount you've deposited across all your accounts to ensure you don't surpass your cumulative contribution limit. For instance, if you have a total contribution room of $20,000 and you've already contributed $10,000 to a TFSA at BankEd, you can only contribute an additional $10,000 across all other TFSAs you might have, whether they're at Bank B, C, or an online brokerage. Furthermore, with multiple accounts, it's easier to mistakenly overcontribute, especially if you're not consolidating records and frequently monitoring each account. If you inadvertently go over your limit, you'll be subject to a penalty fee of 1% of the excess amount each month until it's corrected. Hence, while diversifying across multiple TFSA accounts can be a strategic move, meticulous record-keeping is vital. Lastly, as you manage multiple TFSAs, it's essential to have a clear investment strategy. Understand the purpose of each account, whether it's for short-term savings, long-term growth, or specific investment types. This clarity will help you make informed decisions, optimize returns, and ultimately harness the full benefits of the tax-free savings account. Can you have multiple TFSAs? You should understand that even though the earnings inside your TFSA, whether it's through interest, dividends, or capital gains, are tax-free and won't impact your contribution room, withdrawals from your TFSA can affect your future contribution room. For instance, if you were to withdraw gains from your TFSA, you couldn't just put them back in that same year without considering your contribution room. Let's say you contributed the maximum $50,000 to your TFSA and then made an additional $10,000 in gains. If you withdrew the full $60,000, you couldn't put back $60,000 the same year without overcontributing. However, in the following calendar year, you can recontribute the full amount you withdrew plus any new contribution room provided by the government for that year. In contrast, if you faced a loss in your TFSA investments, the amount you could recontribute would be less. Let's say you initially contributed $50,000, but due to market downturns, your investments dropped to $40,000. If you withdrew the $40,000, you could only recontribute $40,000 the next year, plus the new contribution room for that year. Therefore, while the TFSA provides flexibility with withdrawals, it's crucial to have a strategy in mind. Think about when and why you might need to take out money and the implications it might have on your future contributions. Another key point is that transfers between TFSAs don't count as withdrawals or contributions as long as they are directly transferred between institutions. If you withdraw funds from one TFSA and then deposit them into another, it will count as a withdrawal and a new contribution. So if you're considering moving funds between TFSAs, ensure you complete a direct transfer to avoid any unwanted complications. Lastly, always be aware of the fees associated with various accounts, especially if you're holding multiple TFSAs. Some banks and brokerages may charge transfer, management, or other types of fees. It's essential to be knowledgeable about any costs involved to make the most of your TFSA and its benefits. How CDIC protects your deposits. The Canada Deposit Insurance Corporation, CDIC, is a federal entity that insures eligible bank deposits up to $100,000 in member institutions. You're automatically covered if you bank with a CDIC member institution. CDIC covers checking accounts, savings accounts, GICs, term deposits, and foreign currency. The CDIC does not cover mutual funds, stocks, bonds, cryptocurrencies, or ETFs. In the context of a TFSA, if you have $25,000 in ETFs, $10,000 in stocks, $10,000 in GICs, and $5,000 in cash, the CDIC would only cover $15,000 GICs in cash. And that's a wrap, savvy savers. We've unpacked the ins and outs of tax-free savings accounts. If this has enlightened your financial journey, give it a thumbs up and share it with your circle. Continue making smart money moves and always stay legendary.